Disclaimer.
Quick question. Why is the exact same ounce of silver trading at $100 in Shanghai right now, while Western exchanges try to tell you it's still $90? As you watch this video, we are witnessing the death of the paper market. For the first time in history, physical metal isn't just decoupling, it's disappearing. India is hoarding, China has locked its gates, and the silver you see on your screen has officially lost its connection to the silver you can hold in your hand. If you think this is just another price spike, you're missing the biggest financial reset of our lifetime. Let's look at the evidence. The numbers tell the story. Silver closed at $99.72 today, January 23rd, 2026. That's a $5.80 jump in just 24 hours. Think about that for a moment. This is the same metal that was trading at $31 exactly 12 months ago. We're talking about a 224% gain in a single year for an industrial commodity that powers everything from solar panels to electric vehicles to the AI data centers running our digital economy. But here's where it gets interesting, and frankly, disturbing. When traders in Shanghai want to buy physical silver right now, they're paying 10% more than the Comex futures price. The exchange in New York says silver costs one thing, but if you actually want the metal in your hands in Asia, you're paying a massive premium. According to data from the Shanghai Futures Exchange, this spread represents the widest dislocation between paper and physical markets in modern precious metals history. The pricing mechanism is broken. Let me put this in perspective with a scenario you can relate to. Imagine you're booking a flight online and the website shows tickets for $500, but when you try to complete the purchase, the airline says, actual seats cost $550. Because there's a shortage of available planes, you'd immediately know something was wrong with the market. That's exactly what's happening in silver, except the stakes are exponentially higher because we're talking about a metal essential to the green energy transition every developed nation has committed to achieving. Have you noticed how quickly India entered this conversation? They should grab our attention. According to the Silver Institute, India absorbed 7,158 tons of silver in 2025. That's 21.4% of all globally refined silver that gets traded internationally. We're talking about $9.2 billion worth of a single commodity flooding into one country. Their domestic silver prices tell the real story of what happens when demand meets constrained supply. Prices exploded from 80,000 rupees per kilogram to 327,280 rupees. That's more than quadrupling in a market where supply should theoretically respond to price signals. But supply isn't responding, and India's behavior reveals why the shortage is different from typical commodity squeezes. They're air freighting silver from London. Let that sink in for a moment. Air freight costs 8 to 12 times more than shipping metal by sea. Indian industrial buyers are paying those astronomical transport premiums, rather than waiting the normal 4 to 6 weeks for maritime delivery. The World Gold Council documented these airlift operations throughout the fourth quarter of 2025, and they're accelerating into 2026. This isn't investment speculation, where buyers can wait for better prices. This is industrial panic. Think about what it takes for cost-conscious manufacturers to choose air freight over sea freight. You don't make that decision lightly. You make it when you absolutely need the metal and can't risk production delays. India has 0 domestic silver mines. According to their Ministry of New and Renewable Energy, they've set a target of 500 gigawatts of solar capacity by 2030. Each gigawatt requires roughly 15 to 20 tons of silver, depending on the cell technology. Do the math with me. That's 7,500 to 10,000 tons of silver needed just for their solar build-out over the next 4 years. They're not buying for speculation. They're buying for survival in their energy transition commitments. Now let's talk about what's happening at the exchange where silver futures trade in the United States. The Comex registered inventory data tells a story that should make anyone in financial markets extremely uncomfortable. In 2020, Comex warehouses held 346 million ounces of silver in the registered category. That is metal available for delivery against futures contracts. Today, 82 million ounces. We've lost 70% of deliverable inventory while open interest in futures contracts has remained elevated. The Chicago Mercantile Exchange publishes these warehouse stocks daily, and the trend is unmistakable. Here's what should grab your attention about those March contracts. Traders holding March 2026 futures are doing something unusual. They're rolling their positions backward. Instead of rolling forward to April or May contracts like normal market behavior, they're moving to January and February, demanding immediate delivery. This backward roll is called backwardation, and it signals one thing: physical metal scarcity. According to Commodity Futures Trading Commission positioning data, the shorts on the other side of these contracts are facing a nightmare scenario. They sold futures expecting to settle in cash or roll positions forward indefinitely, but now contract holders want the actual metal and the exchange is hemorrhaging supply. Let me make this personal for you. If you have investments in mining stocks, retirement accounts with commodity exposure, or you're simply trying to understand inflation dynamics affecting your purchasing power, what's happening in silver markets is a warning signal about broader supply chain vulnerabilities in our economy. The metals we assumed would always be available at reasonable prices are becoming strategic resources where access matters more than price. That's a fundamental shift in how commodity markets function. The Comex situation reveals something crucial about modern financial markets. We've built an enormous paper trading infrastructure. Futures, options, ETFs, allocated accounts, all sitting on top of a relatively small physical supply base. The London Bullion Market Association estimates total above-ground refined silver stocks at roughly 2.5 billion ounces globally. That sounds like a lot until you realize annual industrial demand alone consumes 860 million ounces, according to the Silver Institute's World Silver Survey. We're talking about less than 3 years of supply sitting in vaults and allocated storage, and a meaningful portion of that is already spoken for in jewelry, silverware, and investment holdings that won't be sold at any reasonable price. When physical buyers in Shanghai consistently pay 10% premiums, when Indian manufacturers airlift metal at 8 to 12 times normal transport costs, when Comex inventories fall 70%, while contract holders demand immediate delivery, these aren't isolated incidents. They're symptoms of a market where the paper price discovery mechanism has lost connection to physical reality. The futures exchanges were designed to help producers and consumers manage price risk. But they've evolved into primarily financial instruments where 90+% of contracts settle in cash rather than metal delivery. Here's the uncomfortable truth we need to face. Price discovery is moving from New York and London to Shanghai and Mumbai. The marginal buyer determining the real value of silver is not a hedge fund trading futures contracts or an ETF accumulating shares. It's an Indian solar manufacturer who needs silver paste for photovoltaic cells next week and will pay whatever it takes because his production line can't run without it. It's a Chinese EV battery producer who can't meet delivery schedules without silver-bearing components. These are the buyers setting the real clearing price, and that price is substantially higher than what paper markets are indicating. The shortage isn't coming, it's already here. The question isn't whether prices will rise further. Based on current supply-demand dynamics documented by primary sources from the CME Group, the Shanghai Futures Exchange, and India's Directorate General of Commercial Intelligence and Statistics, the question is how high prices will go before demand destruction occurs, or new supply somehow materializes. And in an industrial commodity where 72% of production comes as a byproduct of mining other metals, according to the Silver Institute, supply does not simply increase because prices rise. You can't just decide to mine more silver when it's mostly a byproduct of copper, lead, and zinc operations. What happens when paper markets completely disconnect from physical reality? We're about to find out. The March contracts at Comex represent 65 million ounces of open interest. The registered inventory available for delivery is 82 million ounces. Those numbers might look balanced until you realize registered inventory serves all delivery months, not just March. If even a small percentage of those contract holders stand for delivery, and positioning data suggests an increasing number are doing exactly that, the exchange faces a supply crisis that can't be solved by finding metal at any price because physical silver is already trading at massive premiums in every major market outside the U.S. futures exchange. Let us document exactly how broken this market has become by looking at what buyers are actually paying around the world right now. These aren't historical examples or theoretical scenarios. This is real money changing hands today for physical metal. China's physical silver premiums hit 80% above spot prices in regional markets, according to Shanghai Metals Market data. 80%. You're reading that correctly. If Comex futures say silver costs $90, Chinese buyers needing immediate delivery are paying $162 for the same ounce. Dubai's premium sits at 40% over spot. Japan's secondary physical markets show 60% premiums for available inventory. These aren't minor dislocations you might see during brief supply squeezes. These are the kinds of spreads that signal complete market dysfunction. Think about what this means for your understanding of commodity pricing. We've all been taught that arbitrage keeps markets efficient. If silver is cheaper in New York than Shanghai, traders buy in New York, ship to Shanghai, pocket the difference, and the prices converge. That's economics 101. But arbitrage only works when you can actually get the metal, transport it, and deliver it within a reasonable time frame. Right now, according to trade flow data from customs agencies across Asia, that physical metal simply isn't available for arbitrage because it's being consumed faster than it arrives. The London Bullion Market Association vaults tell another part of this story. LBMA facilities held roughly 1.2 billion ounces of silver in allocated and unallocated accounts at their peak in 2021. Today, those same vaults hold approximately 720 million ounces. We've lost 40% of Londoner's holdings. That's 480 million ounces that left the vault system. Where did it go? According to shipping manifests and import data, much of it went east to Asia, consumed by industrial demand that never returned it to the vault system because it ended up in solar panels, EV components, and electronics that won't be recycled for decades. Shanghai's exchange inventories have hit decade lows. The Shanghai Futures Exchange published warehouse stock data showing available silver at levels not seen since 2015. And back then, prices were hovering around $15 per ounce, with no supply crisis on the horizon. Today, we're at $100 with inventories even lower. That contrast should tell you everything about how demand has fundamentally changed the supply equation in global markets. Here's a metric that really exposes the desperation: silver lease rates. In normal markets, you can borrow silver from banks and large holders, pay a small interest rate, use the metal for industrial production, then return it later. Think of it like leasing a car. You pay for temporary use. Those lease rates typically run 1 to 3% annually in stable markets. During the October 2025 squeeze, according to the London Metal Exchange, lease rates spiked to 200% annualized, 200%. That means if you borrowed $100 million worth of silver, you'd pay $200 million in interest over a year. Nobody pays those rates voluntarily. You pay them when you absolutely must have physical metal and there's no other way to get it. This lease rate spike forced what traders call metal displacement. Silver physically moved from London to New York as Comex struggled to find deliverable supply. The CME group documented unusual warrant activity during this period, with metal being flown rather than shipped between vault systems. The cost of that displacement gets absorbed somewhere in the supply chain, ultimately showing up in premiums paid by end users who need silver for actual production rather than financial trading. Let me bring this to something you might have noticed in your own life. Have you seen solar panel installation costs declining as manufacturers promised they would? They should be getting cheaper as the technology matures and production scales up. But according to industry reports from the Solar Energy Industries Association, installed costs have plateaued or even increased slightly in some markets, despite massive improvements in solar cell efficiency. One of the hidden factors is input costs for materials like silver paste used in photovoltaic cells. When silver prices triple or quadruple, that cost gets passed through the supply chain, eventually landing on your quote for rooftop solar installation. Now let's talk about the event that changed everything going forward. On January 1st, 2026, China activated a new export licensing system for silver. This isn't some minor regulatory adjustment. According to China's General Administration of Customs, the new system restricts exports to just 44 approved companies that must demonstrate annual capacity exceeding 80 tons. That capacity requirement immediately eliminated most of the smaller traders and processing facilities that previously participated in silver exports. China exported approximately 5,000 tons of refined silver in 2025, according to customs data. Their import numbers? About 240 tons. That's a 21-to-1 export to import ratio. They were the world's release valve. When Western markets ran short, Chinese supply filled the gap. That era just ended. The new licensing system gives Chinese authorities direct control over 60 to 70% of globally refined silver supply that moves through international trade channels. Because even silver refined outside China often gets processed or traded through Chinese companies at some point in the supply chain. Why would China lock down silver exports now? Look at their domestic demand trajectory. According to China's National Energy Administration, they're targeting peak carbon emissions by 2030, requiring massive expansion of solar capacity. Electric vehicle production in China consumed roughly 150 million ounces of silver in 2025, according to the China Association of Automobile Manufacturers, and that number is projected to double by 2028. Add in the AI and data center build-out happening across Chinese tech giants, all requiring silver for servers, connections, and electrical components. They're not restricting exports out of spite. They're restricting exports. You can do it because they need every ounce domestically. Think about this strategic move in the context of rare earth elements. China controlled rare earth exports for years, using that control as geopolitical leverage whenever tensions rose with Western nations. According to the U.S. Geological Survey, China still produces 60% of global rare earth supply and refines 85%. That control gave them enormous influence over any technology dependent on rare earth elements: wind turbines, electric motors, defense systems, consumer electronics. Now they're applying the exact same playbook to silver. The timing is particularly significant because Western nations have committed to aggressive renewable energy targets. The European Union's Fit for 55 package mandates massive solar deployment. The United States Inflation Reduction Act incentivizes domestic solar manufacturing. Every developed economy has some version of net zero targets that require exponentially more solar capacity than currently exists. and the solar panel production is fundamentally dependent on silver paste for cell conductivity. There are alternatives being researched, but according to the International Technology Roadmap for Photovoltaic, none are commercially viable at scale yet. Let's look at the accumulated deficit that created this situation. From 2021 through 2025, according to the Silver Institute's World Silver Survey, global silver markets ran a cumulative deficit of 820 million ounces. That's 5 consecutive years where industrial and investment demand exceeded newly mined supply and recycling combined. 820 million ounces equals roughly 10 months of total global mine production. Imagine if the world's silver mines simply stopped operating for almost a year. That's how much metal disappeared from above-ground inventories during this period. Where did those 820 million ounces go? They went into products that won't return to the market. Solar panels last 25 to 30 years. Electric vehicle components last 10 to 15 years. Consumer electronics might last 5 to 10 years before they're discarded. And silver recycling rates from electronic waste are notoriously low because the quantities per device are so small that collection and processing costs exceed the metal value. According to the United Nations Environment Program, less than 20% of electronic waste gets properly recycled globally, meaning 80% of the silver in your old phones, computers, and appliances is effectively lost. But here's what should really concern anyone trying to forecast where this market goes next. A 2026 academic study published in the journal Resources Policy Projects that by 2030, newly mined silver plus recycling will meet only 62 to 70% of annual demand. That range depends on whether new mines come online as expected and whether recycling rates improve. The study analyzes projected demand between 48,000 and 54,000 tons annually by 2030. Even at the low end of demand and high end of supply, we're short 15,000 to 20,000 tons per year. Why can't mining just increase production to meet demand? This is where silver's unique characteristic as a byproduct metal becomes crucial. According to the Silver Institute, 72% of newly mined silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. You're not opening a silver mine in most cases. You're opening a copper mine that happens to produce silver as a secondary output. That means silver production is largely tied to the economics and production decisions of base metal mining, not silver prices. If copper prices are strong and justify expanding a copper mine, you get more silver as a byproduct. But if copper prices are weak, that mine expansion doesn't happen even if silver prices are screaming higher. The primary metal drives the mining decision. Pure primary silver mines represent only 28% of global supply, and those operations take 5 to 7 years minimum from discovery to production, according to typical mining project timelines documented by major mining companies. You can't just flip a switch and produce more silver in response to price signals the way you might with other commodities. The technology shift in solar cells makes this supply deficit even more concerning. Current PERSE solar cell technology uses a certain amount of silver paste per watt of capacity. The new generation of TOPCon and heterojunction cells, which deliver higher efficiency and are becoming the industry standard, use 1.5 to 2 times more silver per watt, according to research from the Fraunhofer Institute for Solar Energy Systems. So just as supply struggles to meet current demand, the solar industry is shifting to technologies that require 50 to 100% more silver per panel. That's like adding a second China-sized market to global demand in the span of 3 to 4 years. Have you noticed how the conversation around renewable energy never mentions material constraints? Politicians and advocates talk about solar deployment targets, but those targets assume unlimited access to the materials needed for production. Silver is the constraint nobody discusses publicly because acknowledging it would force uncomfortable questions about whether our clean energy transition timelines are physically possible, given geological and refining realities. The evidence is overwhelming. Physical premiums at unprecedented levels across every major market. Vault inventories in London, Shanghai, and New York, all declining simultaneously. Lease rates that briefly touched 200% annual. China implementing export controls on 60 to 70% of tradable supply. 5 consecutive years of deficits totaling 820 million ounces. Academic projections showing supply meeting only 60 to 70% of demand by 2030. New solar technology requiring twice as much silver per panel, and 72% of supply coming as a byproduct that can't scale with price. This isn't speculation about what might happen. This is documentation of what's already happening. The paper market still pretends silver is a commodity like any other, but the physical market has already moved to a scarcity premium model where access matters more than price. Shanghai paying 10 to 80% premiums is not irrational. It's the market pricing and the probability that silver simply won't be available at any price if you wait too long to secure supply. Let's do the math that Wall Street analysts are now putting their reputations behind. Citigroup released research projections showing silver at $100 by March 2026 and $110 by the second half of this year. These aren't fringe predictions from newsletter writers trying to sell subscriptions. This is Citigroup, one of the largest financial institutions in the world, telling their institutional clients that triple-digit silver is not only possible, but likely within the next few months based on supply-demand fundamentals. The calculation is actually straightforward once you strip away the complexity. According to the Silver Institute's preliminary data, total silver demand in 2025 reached 1.24 billion ounces. Total supply from mining and recycling, 1.01 billion ounces. That's a 230 million ounce deficit in a single year. 230 million ounces equals roughly 28% of annual mine production disappearing from available supply. Imagine if 28% of global oil production just vanished. Prices would explode overnight. But here's where it gets more intense. India alone needs 6,000 plus tons annually just for their solar build-out according to their national solar mission targets. That's roughly 193 million ounces. China's domestic solar and EV sectors are consuming 15% or more of total global demand based on China Photovoltaic Industry Association data. Add in the rest of the world's industrial needs, investment demand, jewelry fabrication, and you quickly see why 1 billion ounces of supply does not come close to meeting 1.24 billion ounces of demand. Now layer in China's export restriction. If they cut just 50% of their 5,000-ton annual exports, a conservative assumption given their domestic demand growth, that removes 2,500 tons from global trade flows. 2,500 tons equals roughly 80 million ounces. Suddenly, our 230 million ounce deficit becomes 310 million ounces. And remember, this assumes everything else stays constant. It assumes no other country restricts exports, no major mines face production problems, no investment demand increase beyond current levels. Those are optimistic assumptions in a market already this tight. Think about the industrial users caught in this squeeze. You're a solar panel manufacturer with contracts to deliver products 6 months from now. Your production line requires silver paste for the photovoltaic cells. There are alternatives being researched: copper plating, aluminum conductors, various nanomaterial solutions. But according to studies published in Solar Energy Materials and Solar Cells, every alternative currently reduces panel efficiency by at least 2 to 4% compared to silver-based conductors. That efficiency loss is unacceptable in competitive markets, where buyers compare products based on watts per dollar. So what do you do as that manufacturer? You pay whatever price necessary to secure silver supply because the alternative is shutting down your production line or delivering inferior products that lose market share to competitors. This is what economists call price inelastic demand. Normal commodities see demand destruction when prices rise. If copper gets too expensive, manufacturers redesign products to use less copper or switch to aluminum. But silver in solar cells and many electronics applications doesn't have that flexibility at current technology levels. You either use silver or you produce inferior products. The Comex delivery squeeze we're watching unfold has historical precedent that should terrify anyone short silver futures. In 2005, China began stockpiling copper for their industrial expansion. According to London Metal Exchange data from that period, copper prices tripled in 12 months as physical buyers overwhelmed the futures market. But here's the critical difference. Copper has substitutes in most applications. Copper supply can scale with price as new mines open, and copper isn't facing simultaneous supply restrictions from major producing countries. Silver's setup is more extreme on every dimension. Industrial demand is price inelastic because alternatives don't match performance. Supply can't scale because 72% comes as a byproduct of other metal mining. And China just implemented export controls on the majority of tradable supply. On top of this already explosive situation, investment demand is layering in. According to precious metals dealers and ETF flow data, retail and institutional buyers are adding silver positions because they recognize the supply crisis. That investment demand compounds the industrial shortage rather than offsetting it. We are witnessing the first true shortage premium in a globally traded industrial commodity, where physical metal trades 10 to 80% above paper prices, depending on region and delivery timeframe. Futures markets have completely lost control of price discovery. The Comex price is increasingly irrelevant except as a reference point for what you can't actually buy at that level. Real price discovery is happening in Shanghai, Mumbai, and Dubai, where buyers pay premiums for immediate physical delivery. Let me walk you through what happens next, based on current momentum. Silver gained 38% in the last month alone. That's $100+ from roughly $72 in late December. Year over year, we're up 224%, from $31 in January 2025. This isn't gradual appreciation. This is parabolic price action that typically signals either a speculative bubble or a genuine shortage. Given the physical premiums, vault inventory declines, and China's export restrictions, the evidence overwhelming points to shortage rather than speculation. $100 breaks within 30 days if current trends continue. That's not a bold prediction at this point. We're already at $99.72 with momentum accelerating. But what happens after 100? Citigroup's $110 target by mid-year assumes relatively orderly market adjustment. Their analysis likely factors in some demand destruction, maybe some mine production increases, possibly some recycling improvements as high prices incentivize electronic waste recovery. But what if those assumptions are too optimistic? Here's the scenario that keeps silver analysts awake at night. India's wedding season runs from April through June. According to the World Gold Council, Indian weddings consume enormous quantities of precious metals, gold primarily, but also silver for gifts, jewelry, and ceremonial uses. Wedding season demand typically adds 15 to 20% to India's baseline precious metals consumption. Now you've got industrial users who already air freight silver to avoid production delays, facing even higher premiums as wedding season demand hits. They'll pay up early to secure supply, creating a front-running wave of buying that pulls forward demand. Simultaneously, manufacturers globally are recognizing that China's export restrictions mean they can't rely on Chinese supply as a safety valve anymore. Basic risk management dictates that you secure supply from alternative sources or build inventory ahead of critical production periods. That front-running behavior from industrial users compounds the wedding season demand spike in India, creating a perfect storm of buying pressure hitting a market that is already short 230 million ounces before these additional demand sources activate. Traditional commodity trading logic says buy the dip. When prices spike, you wait for the inevitable correction, then add positions at lower levels. That mentality fails catastrophically in physical shortage situations. There is no dip to buy when the underlying shortage prevents normal corrections. Prices only pull back during episodic liquidations, when margin calls hit leveraged paper longs, who never intended to take physical delivery. Those liquidations are violent but brief because physical buyers immediately step in to absorb the selling, recognizing that cheaper prices won't last when metal simply isn't available. Have you noticed how different this feels from normal commodity price spikes? When oil spiked in 2008, the correction came swiftly once demand destruction kicked in and speculators exited. When lumber prices exploded during the pandemic, they crashed back down once sawmills ramped up production. Those were supply chain disruptions that resolved once bottlenecks cleared. This is different. This is a structural supply deficit meeting inelastic industrial demand, with a major producing country restricting exports for strategic reasons. None of those factors resolve quickly. Let's talk about what this means for your financial decision making. If you own silver mining stocks, you are positioned in assets that benefit from both higher prices and the likelihood that silver stays elevated for years rather than months. According to analyst estimates from major investment banks, silver miners' all-in sustaining costs average around $18 to $22 per ounce. At $100 silver, even marginal mines are printing cash. The smart money has already recognized this. According to fund flow data, precious metals mining ETFs saw record inflows in the fourth quarter of 2025. If you're considering personal silver investment, understand that physical premiums will likely remain elevated even if Comex futures somehow stabilize. Dealers are already charging 5 to 15% premiums over spot for coins and small bars, according to retail pricing data from major bullion dealers. Those premiums reflect the reality that sourcing physical metal requires paying up in the wholesale market where the physical shortage is most acute. You're not just buying silver exposure. You are buying access to physical metal that's increasingly difficult to obtain. For those with broader investment portfolios, consider what silver's shortage signals about other critical materials. If silver, a relatively simple metal to mine and refine, can develop this severe a supply deficit, what about lithium for batteries, cobalt for electric motors, or rare earth elements for wind turbines and electronics? According to the International Energy Agency's Critical Minerals Outlook, every major clean energy technology faces potential material bottlenecks. Silver is simply the first crisis to fully materialize because solar deployment happened faster than mine production could respond. The $100 to $110 range isn't the end of this move. That's the range where analyst models based on historical demand elasticity suggest buying slows enough to balance the market. But what if demand elasticity assumptions are wrong? What if industrial buyers have no choice but to pay $150 or even $200 because production lines can't shut down and alternatives don't exist at commercial scale? The precedent of Shanghai paying 80% premiums suggests industrial buyers will go far higher than models predict when physical access is at stake. Think about this from the perspective of a solar company executive. You've signed contracts to deliver panels at fixed prices 6 months from now. You've already received deposits from customers. Your reputation and potentially your company's survival depends on fulfilling those contracts. If silver goes from $90 today to $150 over the next few months, but you need it to maintain production, you pay $150. You don't have a choice. You pass the cost through to future contracts and probably lose some margin on current commitments, but the alternative is defaulting on contracts and destroying your customer relationships. That's why industrial buyers create price inelastic demand. The bigger lesson here isn't just about silver or even precious metals. It's about recognizing when markets transition from normal commodity dynamics to strategic resource competition. Silver has become strategic because it's essential for the clean energy transition every developed economy has committed to pursuing. Countries and companies that secure reliable silver supply maintain their ability to participate in solar, electric vehicles, and advanced electronics. Those without secure supply face production constraints that put them at competitive disadvantage. China understood this years ago, which is why they're restricting exports now. They watched the West control oil supplies for decades and recognize that controlling key inputs for future technologies provides similar leverage. According to geopolitical analysts, China's broader strategy involves securing supply chains for battery materials, rare earths, and now silver, while Western nations focused on financial engineering and service economies. We are seeing the consequences of that strategic divergence play out in real time as physical silver becomes unavailable at prices. Western futures markets indicate should clear the market. What should you do with this information? First, recognize that paper price and physical availability have disconnected. If you need silver for business purposes, secure supply now rather than waiting for corrections that may not come or may be too brief to capitalize on. If you're investing, understand that physical metal or mining equities offer exposure to this shortage in ways that futures contracts or some ETFs may not fully capture. If you're planning home solar installation, get quotes now because silver costs will flow through to panel prices over the next 6 to 12 months. Most importantly, don't wait for financial media to tell you this is happening. By the time mainstream outlets recognize the shortage, physical metal will be even scarcer and premiums even higher. You are watching history unfold. The first major industrial metal entering true physical shortage while paper markets pretend everything is normal. The reset isn't coming. It's already here. The only question is whether you recognize it before the crowd does, or whether you wait until even paper markets can no longer deny the physical reality that Shanghai, Mumbai, and Dubai have already priced in. The evidence is overwhelming, the math is simple, and the timeline is now. Silver at $100 isn't expensive if you need it and can't get it. And increasingly, that's exactly the situation industrial buyers worldwide are facing. Not a question of price, but a question of access. Welcome to the new commodity reality where supply constraints trump price signals and physical possession matters more than paper contracts.